Something is breaking in America, and you can feel it in your chest every time you look at your bank account. People who used to be okay are now struggling. Families who never missed a bill are falling behind. Grocery trips feel like financial emergencies. Rent looks like a second mortgage. And every month your paycheck stretches a little thinner until there's nothing left. This isn't normal. This isn't sustainable. And the hardest part? You're not imagining it. Household savings have collapsed by over 60%, credit card interest rates are at record highs, and more Americans are working 2 or 3 jobs than at any point in modern history. Something is changing in the U.S. economy, and it's not good because it's happening to real people right now, in real time. If you feel like life is getting harder no matter how hard you work, you're right. Let's talk about what's really going on. Before we dive in, if you want, drop in the comments where you're watching from and what time it is there. I'm always curious how far these videos travel. What's happening right now behind the scenes in the global financial system is so alarming that if the average American actually saw the numbers being circulated in overseas banking circles, they'd understand instantly why economists are whispering that something fundamental is breaking inside the U.S. economy. Over the last 6 months, foreign direct investment into the U.S. has dropped by nearly 28%, the sharpest decline since 2009. And the more you dig, the worse it looks. Central banks in Asia and Europe have reduced their U.S. Treasury purchases for 3 consecutive quarters, something that hasn't happened in almost 20 years, and instead they're shifting into regional bonds, commodities, and even bilateral trade arrangements that deliberately bypass the dollar entirely. And here's what should make you nervous. This isn't political retaliation. This is risk management. International lenders are flat out saying the same thing privately, that the United States has become too unpredictable, too legally volatile, too economically erratic for them to treat its long-term commitments as stable. Think about that. The country that once defined global reliability is now classified as a high-variance policy environment, meaning other nations no longer believe America will honor the same rules from one administration to the next. And it's not just governments, private investors are fleeing too. For the first time since the Great Recession, European equity funds have divested more than they've invested in American markets for a full fiscal year. Japanese investment houses are holding their cash onshore because the currency swings between the dollar and yen have become so extreme that analysts are calling U.S. exposure strategically dangerous. And here's the kicker. None of this shows up in the rosy headline numbers Americans are fed because those numbers only track domestic output, not international trust. But global trust is the real engine of the U.S. economy. It's what keeps borrowing cheap, imports flowing, and capital abundant. When that trust evaporates, everything becomes more expensive: your mortgage, your groceries, your utilities, your credit card rates. And foreign markets see a U.S. government lurching from crisis to crisis, slapping tariffs one week, reversing them the next, ignoring economic fallout altogether, and they're backing away fast. The world does not trust American stability right now, and that shift, quiet, steady, accelerating, is one of the clearest warnings that something deep inside the U.S. economic structure is breaking. Because when the world stops believing in America, America's economy stops believing in itself. Major U.S. companies are preparing for a downturn. They haven't publicly admitted yet. A far more subtle, but even more alarming shift is happening inside the boardrooms of major American corporations, and the public has no idea how close these companies believe we are to a genuine economic downturn. You can see it in their actions long before you ever hear it in their earnings calls. In the last 2 quarters, Fortune 500 firms have quietly increased their cash reserves by nearly $480 billion, the largest defensive liquidity buildup since the months leading up to the March 2020 shutdowns. Corporations do not stockpile cash unless they see turbulence coming, and what they're doing next is even more revealing. Hiring freezes are expanding across tech, logistics, retail, and manufacturing. Not layoffs yet, but strategic pauses that always precede contraction. And these companies aren't citing weak demand. They're citing policy instability, import uncertainty, and cost predictability failures. That is the most corporate way of saying The U.S. government is making it impossible to plan even 3 months ahead. Meanwhile, inventory patterns are flashing warning signs. Big box retailers like home improvement chains, electronics suppliers, and auto parts distributors are reducing orders for Q4 and Q1 because they believe consumers are nearing the end of their credit capacity. The average American household now holds over $1.13 trillion in credit card debt, an all-time record with interest rates hovering around 22 to 27%, also an all-time record. Corporations know this is unsustainable, so they're preparing for a collapse in discretionary spending. Shipping data confirms it. Freight volume on major U.S. railways is down nearly 11% year over year, and trucking demand on long-haul routes has fallen to levels not seen since 2016. These aren't random fluctuations, these are recession indicators. But here's the chilling part. Companies are refusing to admit any of this publicly because investor sentiment is already fragile. They're tightening budgets, delaying expansions, renegotiating supplier contracts, building legal war chests, and accelerating automation at a pace that suggests they expect labor disruptions or consumer pullbacks in the near future. They know the economy is wobbling. They know the U.S. is losing international leverage. And they know that if tariffs, inflation, and political volatility continue colliding the way they are right now, the American consumer will break first, and corporate America will break right behind them. When companies start bracing for impact before the public even realizes there's a storm brewing, that's when you know something in the U.S. economy is shifting, and not in a good way. What's unfolding in the U.S. labor market right now is one of the most misleading economic illusions we've seen in decades, and if you only look at the headline unemployment rate, you're missing the seismic cracks forming underneath the surface. The government continues to report unemployment between 3.7% and 4.1%. But what they don't tell you is that this number excludes millions of Americans who stopped looking for work entirely. Labor force participation for adults aged 25 to 54, the core of the workforce, has quietly fallen for 3 consecutive quarters, dropping from 83.5% to 82.8%, which doesn't seem huge until you realize that each 0.1% represents hundreds of thousands of people giving up on finding employment. And here's where things get even darker. Nearly 8 million Americans now hold 3 or more part-time jobs, an all-time high, because one full-time job is no longer enough to survive rising rent, insurance premiums, utilities, and grocery bills that have climbed up to 21% since 2021. And companies are exploiting this desperation. Employers are keeping workers classified as part-time or seasonal to dodge benefits, reduce obligations, and maintain flexibility in an increasingly unstable economy. Meanwhile, wage growth, which politicians love bragging about, has now fallen below inflation again when adjusted for real purchasing power. Meaning, yes, you might be making more dollars, but those dollars buy less every single month. At the same time, job openings are dropping sharply in industries that usually remain stable even in downturns like healthcare support, education, and transportation logistics. That is not normal. That suggests systemic misalignment, not cyclical slowdown. And perhaps the most disturbing trend of all is the explosion of phantom job postings, where companies list positions online they have no intention of filling, solely to appear healthy to investors or to collect resumes for future use. According to hiring analytics firms, nearly 27% of all job postings are now classified as non-active hiring attempts. So while Americans are refreshing job boards and wondering why no one calls them back, the truth is that many of these jobs never existed in the first place. This, combined with the collapse in worker productivity, skyrocketing corporate consolidation, and the growing mismatch between skill requirements in the current workforce, paints a brutally clear picture. The labor market is not strong. It's masking structural decay. Something in the U.S. economy is shifting, and the job market is the canary in the coal mine screaming the loudest. Americans are quietly slipping into an unrecoverable financial trap. Another massive warning sign that most people aren't paying attention to is the unprecedented surge in consumer debt levels so extreme that economists are starting to refer to the current situation as structural insolvency, meaning millions of households will not be able to recover even if the economy improves. Credit card debt has surpassed $1.13 trillion, the highest level in American history. But what's even more terrifying is the interest burden. The average APR on credit cards has hit 22.7%, and for subprime borrowers it's reaching 30 to 34%, which is effectively loan shark territory backed by the banking system. And for the first time since the Great Recession, more than 57% of credit card users carry a balance month to month, meaning the majority of Americans cannot pay off their purchases anymore. They're financing basic living expenses at predatory interest rates. Auto loan delinquencies have climbed to a 29-year high, with repossessions up nearly 32% compared to last year. And the average monthly car payment for a new vehicle is now hovering around $762, which is absolute insanity for a country where half the population can't cover a $500 emergency. But here's the ticking time bomb economists are whispering about. Household savings have collapsed. Pandemic-era savings are gone. The personal savings rate has plunged to 3.4%, dangerously close to the all-time low of 2.9% set right before the 2008 crash. Americans are not saving, they're borrowing to survive. And unlike past debt cycles, interest rates are not expected to drop significantly anytime soon, meaning millions of families are trapped in a compounding interest spiral that will get worse every single month. Meanwhile, buy now, pay later services, which were originally marketed as friendly payment tools, have exploded by over 150%, and now 43% of BNPL users have admitted they are behind on at least one payment. These companies are quietly becoming shadow lenders, holding billions in unsecured consumer risk that goes unreported to credit agencies until the debt explodes. And when households run out of credit and run out of savings at the same time, consumption collapses. And when consumption collapses, the entire U.S. economy cracks because 68% of GDP depends on consumer spending. That's why something in the U.S. economy feels wrong. Because Americans are borrowing money they don't have to buy things they can't afford in an economy that's pretending everything is fine. What's unfolding in the U.S. housing market right now is one of the most dangerous economic illusions we've seen since the early 2000s. But this time, it's not being driven by reckless lending. It's being fueled by a structural failure in supply, affordability, financing, and demographic pressure all colliding at once. On paper, home prices are still rising up nearly 6.7% year over year, but the demand supporting those prices has collapsed. Mortgage applications are sitting at 30-year lows. First-time home buyers have dropped to the smallest share of the market in modern recorded history, and the average 30-year mortgage is still floating between 6.8% and 7.4%, which destroys affordability for anyone outside the top income brackets. And here's the part the media refuses to emphasize. Nearly 40% of all home purchases last year were made in cash, not because Americans are wealthy, but because institutional buyers, hedge funds, foreign investors, and real estate syndicates are swallowing inventory like locusts, while everyday families are locked out completely. This artificially props up prices while suffocating real demand. Meanwhile, homeowners are becoming trapped. Over 92% of existing mortgages have interest rates below 5%, meaning homeowners cannot afford to move without doubling or tripling their monthly payment. This creates housing gridlock, where no one sells, no one moves, and no new supply enters the market. And while all this is happening, construction companies are quietly slowing down new builds because costs for materials, especially lumber, concrete, and copper, have surged again due to tariff volatility and global supply disruptions. Multifamily construction is also on a sharp decline, down over 20% from last year, meaning the pipeline for new apartments that could relieve rent pressure is evaporating. Speaking of rents, they're rising again too. Even after a brief cooling period, rents in major metros climbed 4.8% last quarter, and eviction filings are up over 50% in several states compared to pre-pandemic levels. What we're watching is a housing market that looks strong from a distance but is fundamentally broken. Prices are only rising because institutions are manipulating inventory and homeowners are locked into their properties. But beneath that thin veneer, affordability is dead, mobility is dead, and real demand is rotting. When a market depends on financial engineering instead of organic purchasing power, the correction, whenever it hits, doesn't just hurt homeowners. It shatters the entire economic structure around them. Another massive shift happening in the U.S. economy, and one that should terrify anyone paying attention, is the quiet but unmistakable slowdown in American manufacturing. For the last 18 months, the manufacturing sector has registered contraction readings in the Purchasing Managers' Index, PMI, for all but 1 month, the longest stretch of contraction since the Great Financial Crisis. This means factories are producing less, hiring less, shipping less, and investing less, despite politicians bragging nonstop about reshoring and Made in America revival efforts. But when you dig into the numbers, you see why this decline is happening. Manufacturers are being crushed from every angle simultaneously. Raw material costs have surged because of tariff instability, global supply chain uncertainty, and commodity volatility. Energy costs are up 9 to 14% in most industrial states. Shipping costs to bring parts from overseas have nearly doubled compared to pre-2020 averages, and the workforce problem is catastrophic. Over 550,000 manufacturing jobs remain unfilled because the skill gap has exploded, older workers are retiring, younger generations weren't trained in trades, and companies are scrambling to automate workflows that used to rely on human labor. Meanwhile, demand for durable goods is falling because consumers are broke, maxed out, and prioritizing essentials over big-ticket purchases. Auto manufacturers are slashing output forecasts, appliance makers are reporting year-over-year declines, heavy equipment orders have stalled, and small machine shops, the backbone of American industrial capacity, are reporting the lowest backlog levels in almost a decade. And here's the part no one wants to talk about. Foreign competitors sense weakness. China, India, Vietnam, and Mexico have dramatically increased their share of global manufacturing exports. The U.S. is losing ground not gradually, but rapidly. Even American companies are expanding overseas because they can't predict domestic policy beyond a 90-day window. Several major corporations have openly stated that the U.S. is now one of the hardest countries in the developed world to plan long-term capital investments due to regulatory whiplash, tariff uncertainty, and political instability. Manufacturing isn't just another sector, it's the backbone of national resilience. When manufacturing cracks, everything cracks. Jobs, supply chains, national security, innovation, and economic independence. The slowdown we're seeing isn't temporary, it's structural. And if the U.S. doesn't reverse course soon, we won't just lose factories. We'll lose the economic engine that made America a superpower. The silent collapse of small businesses. The backbone of the U.S. economy is splintering. What's happening to small businesses across America right now is one of the most disturbing and underreported economic shifts we've seen in decades. And if people understood the scale of what's unfolding, they'd realize instantly that the U.S. economy is not adjusting, it's unraveling. Small businesses historically generate nearly half of all private sector jobs, yet in the last 12 months, closure rates have surged to levels not seen since the 2008 crash. According to payroll processing data, 22% of small businesses that operated in 2021 have shut their doors, and the ones that remain are drowning in a perfect storm of labor shortages, supply chain costs, credit tightening, and policy instability. And here's the brutal truth. These businesses aren't failing because demand vanished. They're failing because operating costs have become impossible to sustain. Commercial rent is up over 18% nationwide. Utilities for small storefronts have risen by 25 to 40%, and merchant transaction fees quietly raised by major processors are eating into margins at a level owners describe as death by 1,000 cuts. Meanwhile, access to credit has evaporated. Regional banks, still traumatized from last year's liquidity crises, have tightened lending standards to the harshest levels in over a decade. The rejection rate for small business loans now sits above 40%, meaning almost half of American entrepreneurs cannot finance payroll gaps, inventory buys, or equipment repairs. Add in rising insurance premiums, new compliance requirements, minimum wage hikes in dozens of states, and wildly unpredictable tariff swings that alter wholesale costs overnight. And you have an environment where small businesses cannot forecast their expenses for more than 2 weeks at a time. And while megacorporations brag about resilience, their resilience comes from their ability to dominate supply chains, automate labor, offshore production, and crush competition through economies of scale. Small businesses don't have that luxury. They're getting squeezed out, choked off, and replaced by national chains at a pace that should frighten anyone who understands how fragile a centralized economy becomes. Even worse, consumer behavior is shifting in response to financial pressure. People are gravitating toward the cheapest option, which usually means big box retailers or online giants. So even though Americans love the idea of supporting local businesses, their budgets are forcing them to abandon them. When the backbone of American commerce collapses, the ripple effect hits everything: employment, innovation, community stability, tax revenue, and long-term economic mobility. This isn't a slowdown. This is the early stage of systemic decay, and the disappearance of small businesses is one of the clearest signs that something deep inside the U.S. economy is breaking. Another massive red flag, one that economists are trying desperately not to panic about, is the rapid, destabilizing rise in U.S. energy costs, and not just in terms of what you pay at the pump or on your electric bill. I'm talking about structural weakness in the American energy grid, soaring production costs, resource bottlenecks, and investment shortfalls that are converging to create the most unstable energy environment in modern U.S. history. Electricity prices have climbed over 18% nationwide in just 2 years, and some states are projecting double-digit increases again next year due to grid congestion, aging infrastructure, and maintenance delays. More than 70% of the U.S. grid is over 40 years old, and utilities are warning that they cannot simultaneously maintain aging lines while also meeting the demand of new industrial projects, EV adoption, and population shifts. Blackouts and brownouts. Once a rarity, are now expected seasonal events across half the country. Meanwhile, natural gas inventories are strained, LNG export demand is skyrocketing, and refinery capacity reduced dramatically during the pandemic still hasn't recovered, pushing fuel prices higher even when crude oil prices fall. And here's the part people really don't understand. Energy inflation trickles into every corner of the economy. Higher electricity means higher grocery prices, higher manufacturing costs, higher water bills, higher rent, higher everything. When trucking companies pay more for diesel, that cost hits consumers within weeks. When factories pay more for electricity, their production margins shrink, triggering layoffs or price hikes. And on top of this, geopolitical instability strikes at critical shipping routes. Global supply disruptions and strategic resource hoarding means the U.S. can no longer rely on predictable energy markets the way it once could. Foreign suppliers are forming new alliances, setting new rules, and pricing energy based on regional priorities, not American demand. Meanwhile, domestic political battles over energy policy create whiplash for producers who cannot plan investments beyond a single election cycle. Renewable energy expansion is also hitting bottlenecks, permits, land use disputes, mineral shortages, meaning the transition is slower and more expensive than promised. The result? A U.S. energy ecosystem that is financially unstable, operationally fragile, and increasingly incapable of delivering cheap, reliable power. And when energy becomes unpredictable, the entire economy becomes unpredictable. This is one of the most dangerous shifts happening right now, and most Americans won't realize how bad it is until the lights go out or the bills become impossible to pay. What almost no one wants to admit, but what every major global finance minister is quietly preparing for, is the slow, deliberate weakening of the U.S. dollar's dominance. And if this trend continues even a little bit further, it will trigger an economic shock that the average American household is absolutely not prepared to withstand. You have to understand, the dollar's power is the backbone of American prosperity. It lets the U.S. borrow cheaply, import goods at low cost, keep interest rates manageable, and maintain global influence even when domestic policy is chaotic. But in the last 3 years, that dominance has started to crack in ways we have never seen before. More than 40% of global trade settlements between major economic blocs are now being conducted in currencies other than the U.S. dollar, up from just 13% a decade ago. BRICS nations, which now account for nearly half of the world's population and over 30% of global GDP, are actively building dollar alternatives for international trade, and several major oil exporters, including Saudi Arabia and the UAE, have signed bilateral agreements to accept yuan, rupees, or euros for energy sales. The petrodollar, which has quietly sustained U.S. power since the 1970s, is no longer the unchallenged norm. Meanwhile, central banks around the world have purchased record levels of gold, increasing their reserves by more than 1,000 tons in just the last year alone, something they only do when confidence in U.S. monetary policy falters. And it's not hard to see why. America is running a $34 trillion national debt, with interest payments now exceeding military spending for the first time in history. At the same time, political instability has made U.S. financial commitments unpredictable, and foreign creditors are no longer convinced the American government will maintain consistent fiscal policy beyond a single election cycle. The dollar isn't collapsing, but it is slipping, and that's how collapses start. Not with an explosion, but with erosion. As more nations diversify away from the dollar, demand for U.S. treasuries declines. As demand declines, interest rates rise. As rates rise, borrowing becomes more expensive for the government, for businesses, for consumers. Everything gets more costly. And when the dollar weakens, imports, which the U.S. relies on for everything from electronics to medicine to food, become more expensive, fueling inflation even further. The worst part? Most Americans don't even realize this shift is happening. But the rest of the world does. And when the foundation of your economic power begins to crumble, everything built on top of it begins to shake. This is one of the most dangerous trends forming right now, and it shows clearly something is changing in the U.S. economy, and it's not good. The American standard of living is collapsing faster than anyone wants to admit. What's happening to the everyday quality of life in America right now is the most alarming and urgent sign that something in the U.S. economy is breaking at a structural level. Because for the first time in modern history, the average American is working more, earning more on paper, yet living worse in every measurable way. Look around, this isn't the America most people over 35 grew up in. Nearly 62% of Americans now live paycheck to paycheck, including 48% of households earning over $100,000. Which completely destroys the narrative that only low-income Americans are struggling. Essential costs, housing, food, energy, medical care, child care, are rising faster than wages across every demographic. Grocery prices alone are up over 21% in the last 3 years. But here's the truly shocking part. Package sizes are shrinking so aggressively that the Bureau of Labor Statistics had to launch a new reporting method to track shrinkflation because the deception became too widespread to ignore. Meanwhile, the median rent in the U.S. has climbed to nearly $2,050 per month, the highest on record, while the median income, after adjusting for inflation, is now lower than it was in 2019. Americans aren't just falling behind, they're being financially erased. Medical bankruptcy, supposedly addressed by reforms a decade ago, is back with a vengeance, with over 500,000 Americans entering severe medical debt collections every year. Even basic security is deteriorating. Violent crime in major cities is rising again. Police departments nationwide are understaffed by tens of thousands, and emergency response times are now so delayed that in some regions, firefighters and EMTs are openly warning citizens to prepare to handle emergencies yourself. The mental health crisis is exploding as well, with antidepressant prescriptions up more than 39% since 2018 and overdose deaths hitting record levels. Yet treatment centers remain underfunded and overwhelmed. And here's the part nobody in power wants to talk about. The American dream has inverted. Home ownership, once the foundation of middle-class stability, is now statistically out of reach for over 70% of young adults, while the average American family carries more than $104,000 in combined debt. People are working 2, 3, sometimes 4 jobs just to stay afloat, and even then, they're still falling behind because the cost of existence is rising faster than human effort can keep up. This isn't an economic cycle. This is a societal breaking point. The American way of life is deteriorating in real time, and instead of acknowledging the crisis, Leaders are arguing on television while the foundation of the country erodes beneath everyone's feet. If you want the clearest evidence that something is fundamentally wrong with the U.S. economy, this is it. The collapse isn't coming, it's already here. At some point, we all have to stop pretending everything is fine. Because the truth is, millions of Americans feel this shift happening not in charts or headlines, but in their daily lives. In the fear they feel at the checkout line. In the anxiety that comes every time a bill shows up. In the exhaustion of working harder than ever and somehow falling further behind. Something in the U.S. economy is changing, and ignoring it won't make it go away. But here's the part that matters most. You are not powerless. You're not crazy for feeling uneasy. You're not alone for noticing that life feels heavier than it used to. The sooner we face reality together, the sooner we can navigate it, prepare for it, and protect the people we love from what comes next. So if this video resonated with you even a little, don't just click away and move on. Share your story in the comments. Help someone else feel less alone. Hit the like button, subscribe, and stay connected. Because the more we understand what's unfolding, the better prepared we all become. Thank you for watching. Take care of yourself, take care of your family, and remember, awareness is the first step to survival. I'll see you in the next one.